Welcome to Deloitte's Deep Brief Tax webcast series in Asia Pacific. Our webcast today is from our Corporate Income Tax and Bold Play series and is titled India's Equalization Levy, What Comes Next? My name is Shefali Goradia and I am a tax partner based in Deloitte, India, Mumbai office. I have the pleasure of hosting today's webcast. I have three speakers with me today, Radhakishan Rawal, whom we also call RK, David Watkins, and Manoj Kumar. RK is a tax partner based in the Mumbai office of Deloitte India. David is a tax partner based in Sydney office of Australia. And then Manoj is a tax partner based in Bangalore office at Deloitte India. You may access our bios on the left side of the screen. And before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, all our users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We will do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. And if you want to download today's slides and related publications, please go to the downloads and links box. All mobile device users can view the slides and answer the survey on screen. And if you require an attendance record for this event, please download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Now let me turn to the agenda for today's webcast. We will first have an update on the latest developments on the digital taxation, both at OECD and UN level. RK is going to take us through that. After that, David will take us through the Asia Pacific developments so far in the context of digital taxes. And then Manoj is going to walk us through the overview of equalization levy, the journey so far in India. And then we are going to have discussion over a few case studies, which will be fairly interactive, and we'll discuss some of the practical nuances around the business models that we've seen and the challenges that some of the companies have faced. And then lastly, time permitting, we will deal with some question answers. Now with that, let me invite RK to first give an overview of the latest developments, both at OECD and UN. RK, over to you.
Sure, Shefali. Thank you very much. And good morning and good afternoon to all the participants. So this presentation, as such, can be divided in two parts. In the part which I am dealing with now is something which is happening at a global level, a global approach to resolve the issue. And then the second part and third part, can be seen as what is happening at a regional level and ultimately at India level. Some of these are unilateral measures when the multilateral instruments or multilateral measures do not work out. So we have seen a lot of, activities happening at OECD, inclusive framework on Pillar 1 and Pillar 2. And we just take a stop of, what is the status of that work as of now. We'll only deal with the status of this because we'll have detailed sessions on this, in the coming week. So we'll just, take a very brief note of what has happened. On October 12th, OECD officially released the blueprints of both the pillars. These are fairly detailed documents running to around 480 pages. A very good technical analysis, and good policy rationales, for a lot of things which OECD is trying to propose. However, the work is far from over. There is some bit of technical work which is remaining, which the inclusive framework will do. And also there is a consensus, which is pending. The most important part in this two pillars is the consensus, which is also pending. So that's that's something which is a kind of a major outstanding, so to say. I reproduced two diagrams, two quotations from OECD webcast, which they did. In the way they described is that, well, it's a half glass half full or half glass empty, for the reason that yes, there's a good intention to come up with a consensus. However, there are open issues on which they have not yet been able to solve the issues. The initial deadline was to complete the work, by the end of this year, 2020. Now they've got an extension up to mid 2021. That's what the finance ministers have agreed, in the recent meeting which they had. So that's a current status. What is going to happen next? We have a G20 leaders meeting in November 20 and 21st. The consultation is open for this document, so the submissions can be made by 14th of December. And a public consultation is going to happen in the month of January 2021. By mid 2021, OECD targets to come up with a solution. However, that's not the end of it. After the solution is found, it will take a couple of years to, really create the documents, the legal agreements, MLIs, domestic law provisions, etc. So it's going to take further time to implement this. In very brief, these are fairly detailed, complex, documents, but very carefully drafted and still a work in progress. Next slide, please. On the next slide, what we see is that in the meantime, UN Tax Committee has started working on this. The UN committee started working on this, in a recent 6 months time. They have done a lot of progress around this, and their solution is much simpler. They're proposing a new Article 12B. That adopts a structure with which we all are very familiar. It looks like an article on interest, dividend, royalties, fees for technical services, which has been practiced in the existing tax treaties. The article gives taxing right to the source country, and at the option of the recipient of income, the income could be taxed on a gross basis or on a net basis. So the service provider, the non-resident who is earning income, can decide whether he wants to offer his income on a gross basis, the gross withholding. The rate could be in the range of 3 to 5%, or it should be on the basis of net basis. The income which is subjected to tax is income from automated digital services. There's a very clear definition of ADS which they have given here. And the definition, sort of mirrors or adopts a lot from the work which is done by OECD Inclusive Framework in Pillar 1. So that is a taxing right given to the source country under this provision. UN model, UN solution as such does not focus on CFB, consumer-facing business, which is another part which is dealt with in OECD model, OECD solution, but they are looking at only on automated digital services. They have a similar concept of positive lists and negative lists, so they can go on expanding or contracting depending on how the businesses develop. Next slide, please. So this slide, deals with how net basis of taxation is going to work out. This is at the option of the taxpayer. So the formula is very simple. The taxpayer can offer its income to tax at the rate of, on a qualified profit, which is 30% of the revenue source from a source country. So there's a concept of profitability ratio, which is a very simple concept, which is derived by, on the basis of total annual profits and the sales revenue. So that's how you derive at a profitability ratio. That ratio is to be applied to gross revenue derived from a source country, and 30% of that becomes a qualified profit, which is to be offered to tax in the source country. Now, on the screen, what you see is that there are 4 iterations. There are 4 alternative manners in which the qualified profits can be derived at, and that's for the reason that it will depend on 2 variables. The 2 variables are the MNE could be working as a standalone entity, or it could be a group entity. So, this is the first variable. And second variable, the MNE may have prepared segmented accounts, or it may not have segmented accounts. So, this when you consider both of them, you arrive at 4 iterations, and that's how, there are 4 columns you see in the table. There's another rider there, that one can adopt a group ratio only if the group profitability ratio is higher than the profitability ratio of the individual entity. So this is how a qualified profit of is to be arrived at for purpose of Article 12D. It's a very simple mechanism. However, as I said, this is still a work in progress. The UN committee did have a meeting last week. So they have covered a good ground in that meeting. However, a lot more technical work is to be done, and obviously there's a question of consensus to be arrived at. On the next slide, what I've done is I've tried to give a very brief comparison, or high-level comparison of what is there on the OECD solution and the UN solution. Next slide, please. Yes. So here, if we see, OECD Pillar 1 deals with ADS and consumer-facing business, CFB. The UN proposal deals only with ADS. OECD of subjects to tax on net basis. UN proposal gives an option of gross basis and net basis. There are no thresholds which are provided in the UN model, and this could be one of the reasons why the developing countries, the market jurisdictions could be much more happier, because they get to tax every single penny of the revenue which is going out of their country. There are very detailed revenue sourcing rule in the OECD proposal. There are no sourcing rule as such as of now in the UN model. However, this issue has been considered by the committee, and they're going to further work on it. There's the concept of amount B and C in the OECD solution. There's no concept of amount B and C in the UN solution. Very interestingly, the assessment or the tax audits in the OECD model, the OECD solution happens at a group level. So the profits of the group is first arrived at, and a portion of that profit gets distributed, gets allocated to the market jurisdiction in the form of amount A. There is no such mechanism, in the UN model, so that's why it's a far more simpler in that sense. Implementation mechanism, OECD clearly requires new MLI provisions, amendments to the domestic law, and they're going to give a guidance on how this gets implemented. As against that, UN model, gets implemented in the form of a particular specific article in the tax treaty. So, that's a simpler way of implementing this. However, they will need something like a MLI for bringing this provision quickly in the tax treaties. Complexity levels, merely on this ground, UN proposal is far more simpler. It runs into, very few pages as compared to detailed, complex, mechanism of OECD. OECD solution, requires rewriting several laws. It completely changes the dynamics of international taxation, whereas UN provision does not do that. It's much simpler. So that it's a broad comparison of the OECD solution and the UN solution. Both of them are still work in progress. And the consensus is yet to be achieved. The main difference here is that OECD is working on a consensus basis. The UN does not have that concept. UN committee, if there is no consensus, they will record a minority view in the committee, and they will post that. So on the next slide. Next slide, please. Yes. So that brings us to the first polling question. Now, having understood the broad parameters of OECD solution and the UN solution, a question to be answered is, given a chance, what is that you would prefer? Either the preference would be OECD Pillar 1 approach or UN Article 12B approach. And the answers are 1, UN Article 12B, for the reason that it's much a simpler approach as compared to OECD. Second answer is that you go with Pillar 1 approach because that's much more meticulous approach they adopted. This is very carefully drafted. And third answer is probably it's too early to decide, and that's not applicable, or I don't know what kind of answer. So while we wait for the answers, Shefali, over to you now on this.
Thank you, RK. I think thank you for giving us a very, very quick snapshot summary of what's going on both at OECD and UN level. Maybe I think if you can tell us a little bit more about, does UN have a view yet on what do they think about this consumer-facing businesses being in scope? Because while OECD has now been talking about the automated digital services and the consumer-facing businesses, the UN current proposal only addresses the automated digital services. Have they thought about what they are looking to do for the consumer-facing businesses?
So, Shefali, what I gather from the deliberations so far, is that probably they have not adequately applied their mind on this. Okay, their approach is that in the current environment, the priority is to target digital business. That's why they have started with digital ADS, and going forward, they'll decide how to go with consumer-facing business. So it's open as of now, but they are prioritizing the work on ADS.
Right. So we have the results from our first polling question on the screen. Almost 40% of our audience believes that the UN Article 12B is a simpler approach. And Pillar 1 is looking more and more complex, whereas about 27.5% of our audience still feels that Pillar 1 is a better approach to go with, as OECD has adopted a very, very meticulous approach on it, and it has a global consensus, which is more important for reaching a solution on the taxing digital economy. And whereas I think 32% of our audience feels that they don't know yet. It all depends on finally how both the proposals turn out. Okay, so with that, let me now turn to David. Having looked at the global developments, David, could you take us through what's happening at the Asia-Pacific level so far? I mean, which other countries are adopting digital taxes in Asia?
Sure. So the global plan is a long-term consensus plan, but of course what we've got in the short term is countries are acting now. And this global map gives a sense of the divergence that we've got right across the world, in North America, in South America, in Europe, and in Asia. There are digital service taxes or variations of them at different stages of progress, whether they're proposed, contemplated, in force, etc. So the country approach, the individual country approach is already starting to emerge and is becoming quite confusing and quite divergent. And if we move to the next slide and more specifically look within Asia, we can see how there is this divergence of approach that just a number of countries in Asia have already adopted. Obviously, India has moved with the Equalization Levy, but elsewhere in the region, and let's sort of start top left and just go around this slide, Taiwan has introduced some domestic law changes to deem certain income to be Taiwan-sourced income and hence fall within the domestic taxing rules within Taiwan. Indonesia is going down a different path, which is to deem a PE where non-residents have a significant economic presence. Malaysia, in the middle of this slide, is deeming certain payments to non-residents in relation to advertising to be royalties and hence subject to royalty withholding tax. Vietnam is doing something a little bit like Indonesia, requiring foreign suppliers who do not have a PE to be treated effectively as if they do have a PE. New Zealand, over on the far left, bottom left of this slide, is New Zealand's just had an election in the last week or two, and pursuant to pre-election promises, it looks like New Zealand will push ahead with kind of more of a traditional digital services tax, a little bit more like the UK or the European models that we've seen. So, you know, just across those 5 or 6 countries in Asia, what we're already seeing is, firstly, countries are acting now. They're not waiting for a global consensus. And secondly, the way that countries are acting is in a number of different ways. So there is not a consistent approach across the countries that are already moving. On the next slide, I also just note that a number of countries are still sitting on the sidelines in the region. Australia, for example, did consider adopting a digital services tax. At the moment, that is off the agenda, and the Australian government is focused on the OECD longer-term solution. At the same time, Hong Kong and Singapore, and they're countries that the OECD are referring to as investment hubs, they are also observing the shifting in the global landscape and trying to identify their role in a changed global international tax regime. And the Philippines, I guess a little bit like Australia, sitting on the sidelines now, ready to act once there's consensus. So I think the consistent themes across Asia is, you know, change has already started to happen and will continue to happen. And the reality, once countries do go down a unilateral approach, is that there is quite a divergence in the response that different countries adopt. Thanks, Shivali.
Go through the next polling question on this. If each of you can just talk from your group's perspective, are you confident in dealing with these impact of digital service taxes on your businesses in all countries that you operate? Particularly knowing that, you know, some countries have net basis taxation, some countries have gross basis taxation. There are different thresholds and different in scope and out of scope activities. Would you say that, you know, you are confident? Yes, or would you say that no, you have concerns in understanding the scope in all countries? No, but you are actively evaluating. Yes, you have concerns with the accuracy of the data, and they don't know yet. So if you could just put in your comment there. And while we have the answers, David, let me turn to you for something. It is interesting, you know, that while, you know, Australia and Hong Kong and many other countries are still waiting to see what happens on Pillar 1, there seems to be an evolving concern throughout Asia on the impact of Pillar 2. Do you think that, you know, is this something which is likely to catch the wind earlier in the day for at least the Asia-Pacific countries or the financial service centers?
Well, I guess up until now, Pillar 1 and Pillar 2 of the OECD approach have been seen as being part of a combined package. We know that the delivery of that consensus has now taken longer than expected for various reasons. I think there is a possibility that those two pillars might become disconnected. One might go ahead of the other. But of course, the interesting thing about Pillar 2 is that really does not need a consensus, an all-in approach like Pillar 1. Individual countries could move to adopt something that looked like aspects of Pillar 2 right now. So it may be that Pillar 2 moves ahead of Pillar 1. There's a lot of uncertainties ahead.
Right. So we have the results on the poll again. Again, close to 40% of our audience believes that yes, there is a concern in understanding the scope in all the different countries. But together with the second one, you know, at least close to 70% are either already actively evaluating or considering the impact on the businesses. very few have, fully understood but still have concerns over the accuracy of it. So with that, let's move on to the next one. I think the topic for today, coming closer down to the country level, we will now talk about the overview of equalization levy in India. Manoj, can you take it over from here?
Sure, Shefali, thank you. And if we now look at India on what's been the story so far in respect of the equalization levy, like we all would have gathered, India has been an early mover on taking actions in relation to the challenges of taxation that have arisen. Right after the BEPS announced the action plan in 2015, India actually introduced the equalization levy in 2016, and the version 1 of the equalization levy was applicable in respect of online advertising services and related services. Moving forward, India also introduced the special economic presence scope in the domestic law itself, which made foreign enterprises who interacted with users beyond a specified threshold or had transactions beyond a specified threshold who could be subjected to tax in India as a business connection. However, in 2020, India deferred the concept of the applicability of significant economic presence to FY 21-22 and expanded the scope of equalization levy to cover a far wider scope of transactions and activities. If we move on to the next slide. Like we said, the 2016 equalization levy applied at the rate of 6% on online advertising services and related services. And the obligation at that point in time, or on this category of services, is cast on the payer to withhold equalization levy and remit it to the government. The expanded scope of equalization levy, which we can call as the version 2 of the equalization levy, applies at the rate of 2% on consideration received or receivable by an e-commerce operator from e-commerce supply or services that are made to specified payers. Along with introduction of this levy, which has been introduced as an independent code outside of the income tax law. In the income tax law, the government has also introduced a specific exemption in respect of foreign enterprises who derive income that are subject to equalization levy. However, for the equalization levy version 2, the exemption is applicable from 1st of April 2021, while, of course, equalization levy 2 is applicable from 1st of April 2020 itself. If we now take a look at some of the key definitions in relation to the equalization levy, the first one being the e-commerce operator. An e-commerce operator is a non-resident who owns, operates, or manages a digital or electronic facility or a platform for online sale of goods or online provision of services or both. While it is simple to understand the definition in the context of a typical platform where products are sold by an e-commerce operator, the words used here being digital or electronic facility seem to widen the scope of what all could be covered within the ambit of an e-commerce operator. The questions may be in terms of can a private channel and a private mode of communication between parties be regarded, make the foreign enterprise be regarded as an e-commerce operator. And the other view to look at is going to be only a mass communication channel that allows a foreign enterprise make online sales or undertake e-commerce should be regarded as an e-commerce operator. The second view should be a better view in the context of how this law has been drafted. The next definition is on e-commerce supply or services. E-commerce supply or services is defined as any online sale of goods or any online provision of services or facilitation by an e-commerce operator of either of the above. Now, even here, the important aspect to be examined is what will constitute online sale of goods, and similarly, what will constitute online provision of services. Where is it important that all the key elements in relation to the sale, be it finalizing the terms of contract in relation to the sale, be it the delivery of the product or the service, and be it the transfer of title in relation to the products. Should all of these be transacted online for the sale to be regarded as online sale, or if any of the key elements in relation to the sale are conducted online, will it be regarded as an online sale? There is not absolute clarity on this aspect. While even the representatives of government have in public forums indicated their view that the intent is to cover transactions where any of the key elements, when they're transacted online, the sale should be regarded as an online sale, which will mean that even physical goods can be, when sold online on a platform, should be regarded as an online sale of goods. Now, while the argument may be slightly better for online provision of services, given that the term used is provision of services and not an online supply, where we could, therefore, where you would further argue that provision should mean an online provision itself of the service. Okay. If we move to the next key definition, is in relation to specified payers. So an e-commerce supply or services made to specified payers would be subject to equalization levy. The specified payers are a person resident in India, which is a straightforward situation. Any sale made to a person resident in India should be subject to equalization levy. A person who buys such goods or services both using an internet protocol address located in India. This throws up some interesting circumstances. Potentially non-residents who are traveling into India and use IP addresses in India for making purchases could be subjected to the levy. In fact, procurement functions of various companies are outsourced into India, and it may be important to examine whether when the procurement activities are actually done in India and orders are placed in India for non-resident enterprises through IP addresses in India, would those transactions also be subject to this levy? The third category is in case of transactions between two non-residents, they will be subjected to the equalization levy only in specified circumstances, which is when it is a sale of an advertisement targeted to Indian customers or customers using IP addresses in India, or when it involves sale of data collected from an Indian resident or a person using an IP address in India. Here also it may be relevant to examine in case of global transactions between two non-resident residents. If a global sale of business by one company to another entails data in relation to Indian residents that is also being passed on, it may be important to examine whether that value attributable to that portion of the transaction could be subjected to equalization levy. Now, if we move on to the exclusions from equalization levy, the exclusions are as follows, which is on the bottom left of the screen. A non-resident e-commerce operator having a permanent establishment in India and where the e-commerce supply or services are effectively connected with such permanent establishment are excluded. Here, the term permanent establishment is defined under the equalization levy provisions to be a fixed place of business through which the non-resident enterprise carries on its business partly or wholly. It may be noted that this is the definition that is independently outlined and it's not linked directly to the definition under the treaty or to the definition of business connection as we have it under the domestic law in India. And therefore, this will have to be separately examined. This also throws up an interesting planning opportunity potentially that non-resident enterprises can consider. If a non-resident enterprise, an e-commerce operator operating with a thin margin, let's say a 5% margin, had the choice of operating in India with or without a permanent establishment, if the non-resident operator, let's say, sold goods of $100 into India and had a 5% margin, if there was a P established, the $5 margin would be subjected to tax in India at a net basis, and let's say at a rate of 42%, the tax would be about $2.1. In the same kind of a fact pattern, if the non-resident operated in India without a permanent establishment, the equalization levy of 2% could apply in respect of the non-resident e-commerce operator. The other cases that are excluded from equalization levy is when the non-resident operator is already subject to the levy under the equalization levy version 1 provisions that were earlier announced, or where the sales or the turnover or gross receipts of the non-resident e-commerce operator from the online sale of services are less than 20 million INR rupees during the financial year, which is roughly about $270,000 during the financial year. Now, if we move on to the compliances for a non-resident e-commerce operator, while the earlier levy, like I mentioned, casted an obligation on the payer to withhold the equalization levy and remit it to the government, the version 2 of the equalization levy cast the obligation on the non-resident e-commerce operator to remit the taxes on a quarterly basis within the 7th of the next quarter for the first 3 quarters, and within 31st March in case of the last quarter. Therefore, for this financial year 2021, the first 2 quarters, which is April, May, June, the amount of equalization levy was supposed to be paid by the July 7th. For the second quarter, which is July to September, the equalization levy was to be remitted by the 7th of October. The next 2 quarters will pan out as we move forward. The non-resident e-commerce operator is required to obtain a registration and to undertake weightings and compliances under the law as is outlined. Last week, in fact, the government has issued updated rules for non-resident e-commerce operators, outlining the form for the annual return and also forms for various appellate levels. Any delay in remittance of the equalization levy by the non-resident e-commerce operator attracts an interest at the rate of 1% per month or a part of the month, which is in line with the interest that applies under the income tax law. And failure to remit the equalization levy attracts a penalty at the rate of equivalent to the equalization levy that could potentially apply. So the cost of non-compliance is quite significant. If we now move on to the next slide, if you look at the business models that get impacted by the equalization levy, the more obvious ones are the online marketplaces, the non-resident online marketplaces that are accessing the consumer bases in India. Online content companies, whether it be for streaming, whether it be for online courses, whether it's for gaming or e-learning or for database accesses, packages that are sold by non-resident enterprises directly into India. Licensing of softwares and licensing of IPs potentially gets impacted, and we will come to the interplay with royalty in a bit. Reseller and distribution models potentially get impacted, including intra-company transactions. Search engine companies, credit card network companies, all of them potentially get impacted by this levy. If we now just have to list down the key practical issues or administrative issues, and just before we go into it, and if we have to look at what are the aids to interpreting all these clauses and terms of the equalization levy, at this stage, the equalization levy 2 version that got announced does not have a detailed memorandum, or there have not been any specific clarifications issued by the government clarifying various aspects of the levy that we just discussed. Therefore, reliance is only placed on the background documents that are available, which is an e-commerce committee report that was issued by a committee set up by the CBDT in 2016. Some persuasive value can be placed on the memorandum to the finance bill in 2016, and maybe to the BEPS action plan, which is the origination of this levy. India has also filed a response to the objections that were raised by the US government in relation to the equalization levy. And there is the response by and large indicates that India has to create a level playing field between non-resident e-commerce operators who are able to access the Indian market versus the Indian e-commerce operators who are making sales into India. And the overall intent of this levy is to ensure there's a level playing field and there's no discrimination between these parties. Therefore, that is the background with which we may have to look at various aspects of this levy. Some other aspects that remain unanswered are, whether the levy should apply on gross consideration derived by the e-commerce operator, or should it be on really the income of the e-commerce operator? Because the term used in the levy is any consideration received or receivable by a non-resident e-commerce operator is subjected to the levy at 2%. If the supply chain includes multiple level e-commerce operators, will the levy apply to each e-commerce operator independently, or should it apply at one level is the other question that will remain unanswered. The interplay with royalty and fees for technical services. Currently, the framework of law entails anyway a tax at the rate of about 10% in case of royalties and fees for technical services derived by non-resident companies from India. When these streams of incomes are subjected to equalization levy, these streams are also entitled to an exemption provision that we just spoke about, and that exemption provision is applicable from April 1st, 2021. Does it mean that the levy now moves away from all the income streams that were subject to tax at 10% now will be subject to tax on equalization levy at the rate of 2% on a gross basis? The next one is, okay, we spoke about the exemption being applicable from 2021, while the equalization levy itself is applicable for the financial year 2021. So in the year 2021, both the levies continue and apply. The royalty and FTS gets taxed at 10%, and the equalization levy of 2% continues and applies. There is, at this stage, the law does not provide any exemption or any relief in respect of the double levy. For non-residents, the other question is, how do you comply with all the requirements under this law in India? Do you have a choice to appoint an agent? While specifically the law does not outline this, we believe that even under the general framework of the income tax law, non-residents could appoint independent consultants in India to comply with the provisions of this law in India. Of course, the law, in fact, contemplates that specific categories of persons could be regarded as an agent of the non-resident in India in specified circumstances, and in fact, the agents of the non-residents could be regarded as representative assessees of the non-resident in identified circumstances. The other issue in respect of the levy is tracking the receipts from India, tracking the income that is subject to this levy, and of course tracking, in case of non-resident to non-resident transactions, how much of the advertisement revenue and the specified circumstances will be subject to this levy in India. These are some of the practical aspects that will have to be dealt with. Back to you, Shefali. So having understood or looked at the overview of the equalization levy, if we come to the next polling question, do you think as a company we are technologically ready to comply with the equalization levy? Are the internal systems ready? Are we ready to track the revenues that are subject to the levy? Are the exact details available to us? The options are yes, the team joined the accounting team is making efforts and is ready to deal with it. The other one is yes, but there is not as much clarity on the scope and the accuracy of data that can be culled up to deal with this levy. The third one is no. It's difficult because various global systems are in place, and it's difficult to change the global systems to identify what portion of the income. Last one being not happy with it.
So Manoj, while we are waiting for the questions to be answered, can I ask you a question here?
Yeah, sure.
Right. So Practically speaking, do you think that if the non-resident does not pay the equalization levy, will the Indian buyers, will they have any obligation?
Right. Shifali, the current framework for the version 2 of the equalization levy, the current framework of the doesn't cast any obligation on the buyer to either withhold or to remit the equalization levy. However, the administrative provisions under the income tax law, which are also applicable in respect of equalization levy, actually cover certain circumstances where and even the payer of the income could be regarded as an agent of the non-resident. The agent of a non-resident could be regarded as a deemed assessee or a representative of a non-resident in India. So, in case the non-resident operator does not comply with the levy, the buyer has to be within these agency provisions and the representative assessee provisions under which the revenue authorities could maybe go after them. But law at this stage does not cast an obligation on the.
Okay, got it. So we have the results on the screen. Almost 40% of our audience does believe that it is difficult to get the global systems changed so quickly to be able to track this data and to comply with the new provisions which were introduced, almost as a last-minute decision without giving much guidance or prior notice. So with that, let's move over to our next section, which we have is on the case studies. And we will quickly go over the case studies. I think many of the issues you've already seen it. Can we have the next slide, please? Where we want to bring out some of the nuances. Now, if you see in this case, there is this foreign vendor which owns a web portal on which the customers can place an order. Now, this is not a case of a classic e-commerce operator, as we understand, but this is a foreign company that is already selling its own goods through its own web portal, and the goods are then physically shipped to the customers all over the world. In this case, let's say ICO is buying the goods and the goods are being sold to India. And the payment is also effected on the same web portal, post which the goods are delivered. Now, in this particular case, Manoj, let me just turn to you. You talked about the whole nuance around the physical goods versus digital goods. Is there any way in this in a plain vanilla case, if the orders are received on the web portal, is there any way the foreign company can say that they are not subject to equalization levy?
Yeah, like you mentioned, if the online portal and the platform here is where the entire sale takes place, then of course there is no dispute. And for physical goods versus digital goods, while on a very strict interpretation, we can say when element has to be done online for it to be regarded as an online sale. With that interpretation, we could argue that only digital goods are covered. But given the context and the framework it will also be covered under the current framework. And only if you're able to again say the sale is not, all terms of the sale are not included online, there may be an argument to say that the sale is not actually concluded on the web portal. So if the portal, for example, is only a site to go and look at and to place an order, and subsequently there is an interaction required to conclude the terms of the sale, maybe in that circumstance, there will be a view that this could be different.
Right. And if, let's say, if it were not the case of digital goods, but if it was, say, some digital services, right? Would you then also have the additional impact under the GST? Because this would then be covered within the OIDA regulations?
Yeah, so that is also right. So the equalization levy on its own doesn't preclude the application of the other indirect taxes, while there has been some amount of debate on whether equalization levy is in the nature of a direct tax or an indirect tax. The GST regulations in India separately apply or entail tax in case of provide online digital services by a non-resident enterprise. On a B2B basis, it is on the non-resident, and on a B2B basis, it's on a reverse tax by the resident. So OID will continue and apply independent equalization levy being application.
Right, and then if you compare this, e-commerce operator is now getting to be a common concept under various laws, right? You have the definition under the GST laws, you have it under the consumer protection laws. Is there any consistency or any points of distinctions that you see?
Finally, their e-commerce operator has been defined independently under each of the regulations, be it the consumer protection laws, which define an e-commerce entity, which has various obligations. Under the GST law, an e-commerce operator is separately defined. Under the income tax law itself, there is a definition for an e-commerce operator where a withholding tax obligation has been cast. Under the FINA regulation, the e-commerce entity is separately defined. While under most of the other regulations, the common theme seems to be an e-commerce operator is largely a platform and doesn't include a selling entity on its own. That I think is the distinction between the equalization levy and all the other laws. The equalization levy also includes the selling entity itself, the e-commerce operator.
Right. So to be clear, then I think in this particular case, where the FCO is just selling its own goods, it may not be subject to the other taxes, whereas, or at least it may not be regarded as an e-commerce operator. Whereas in this particular case, I think for equalization levy, being the broad definition that we have, it might be covered. And then I think you did allude to it that, instead of, let's say, the orders going online, if there was a one-to-one email communication of the orders and the goods were just being shipped from abroad, then it may not be subject to an equalization levy. And therefore, you have to see what your business model is. And if you're able to plan around, not receiving the orders online, at least as far as the physical goods are concerned, it is, then at least it's a more reliable position to fall outside the purview of equalization levy. Let's move on to the next case study, which then relates to a classic case of an e-commerce operator, where you have FCO, which is operating an online marketplace. It sells goods to an Indian customer, say worth $100, and it receives that $100 from an Indian customer, and then it passes it on to the foreign vendor. Now, in this particular case, the FCO does not retain his listing fees. It pays out the entire consideration to the foreign vendor, and then the foreign vendor separately pays this $10 of listing fees to the FCO. Manoj, in this particular case, what do you think will be subject to equalization levy? Will it be 100 minus 1090? Or will it be 100 as the entire consideration? Or will it be 100 as a consideration going from the Indian customer, plus that additional $10 of listing fee?
Right. Yeah. So just before we get to consideration, here FCO clearly being online marketplace will be regarded as the e-commerce operator. And the definition, if you look at it, says any consideration received or receivable by the e-commerce operator is subject to equalization levy of the rate of 10%. So going vanilla with the definition, the entire consideration which is received by the e-commerce operator should be subject to the equalization levy. Now, the only arguments on the flip side are that if the $100 received by FCO, the consideration at all of the of FCO, and should we say it is not a consideration received by FCO, it is only an amount that FCO is receiving on behalf of the vendor and is being passed on to the vendor, given the detailed terms and the manner in which it operates. But otherwise, FCO should be subject to tax on the entire consideration of.
if you talk a little bit about the different models that we see. So, for example, you could have a situation where the foreign vendors could be selling goods themselves, but in addition, they may be using some online portals to also sell their goods. And you could have some situations where there is a flash sale before onward sale to the Indian customer, or in some cases, it's just a FCO taking its commission or a fee for facilitating the sale. Or there could be multiple foreign vendors in between, where you have the cases of regional distributors or the local resellers. Would you have the case of many more entities than treated as e-commerce operators, or which particular entity would have an obligation to pay the equalization?
Again, Shefali, at this stage, I think while the law does not specifically clarify whether, if you look at a supply chain completely, should only one person in the supply chain be regarded as an e-commerce operator, and should multiple persons in the supply chain be regarded as e-commerce operators? If we look at it in two ways, if you say that every person in supply chain could be regarded as an e-commerce operator, and you could have multiple e-commerce operators, and each of them should be subject to tax or equalization levy in respect of their respective income or consideration, and only that should be subject to equalization levy. That could be one extreme view. The other view could be an e-commerce operator is the first entity which has the interface with India, and the entire consideration is flowing through that entity is subjected to the equalization levy, and does not seem, the law does not seem to intend to tax the same from multiple times under equalization levy, and therefore when the first non-resident entity having interface with India is subject to equalization levy, that itself will be sufficient.
Right. If we can move to the next case study, where we have the case of other payment gateways, right, which are involved. Let's say in this particular case, the customers don't pay to the FCO, but they pay to PICO, which is operating a payment services. And in this case, would you then say that PICO becomes an e-commerce operator? Would they have any obligation towards equalization levy?
Yeah, here I think the important question here is, one, PICO would have a web portal of its own, and if PICO really facilitating the sale at all, because PICO is only a payment gateway, by facilitating a payment for the sale, and we regard PICO as facilitating the sale itself is the question. If you say that PICO is not facilitating the sale, PICO is not subject to tax in respect of the equalization levy. And then the transaction is looked at from an FCO point of view separately, whether FCO is an e-commerce operator. Else again, PICO gets subject to taxes.
Right, and as you, I think, already mentioned, only the intent seems to be that, rationally, only one entity should be really paying the equalization levy. The intent does not seem to be collected multiple times. So long as there is an understanding and making sure that at least one entity is paying this, probably the better view could be that the payment service providers should not be caught within the net. Moving on to the last case study, I think this one particularly talks about the software, which is where we have this added controversy, and whether the sale of software, is it goods, is it service, is it just a right to use the IP? And whether is this royalty, subject to a royalty withholding tax or equalization levy? Manoj, would you talk a little bit about the different models that we are seeing in this context?
So again, various IT companies have varied models under which softwares are sold into India, whether it's off-the-shelf software, whether it's package software, whether it's database access packages, whether it's sold under distribution models. And some of these models will also apply in case of content companies. And in case of embedded software, most of these in India, at least, there is under dispute, and the dispute is pending with the Supreme Court, which is the apex court in India, to determine whether payment for all these for software is regarded as royalty under the treaty, while there is a inclusion under the domestic law. The framework of equalization levy, the way it currently operates, is all of these are envisaged to be covered within the scope of equalization levy. And once they get covered there, being an online sale, all of these could be entitled to an exemption under the income tax law. So that will create an issue on the taxes that are being disputed by revenue authorities today. Again, very recently, in a rate petition that was filed by a large payment gateway company, the government seems that the intent is not to collect both the levies, and in case foreign companies manage to be subjected to tax in India, the equalization levy will not be collected. The foreign companies not subjected to tax in India, equalization levy will be collected with interest.
Right. Thank you. I think this is all an interesting debate, and hopefully, at least on some of these aspects, we should now look to the budget announcements on February 1 to see if more clarity can be given. Thank you, Manoj, RK, and David. I think this brings us to the end of our today's discussion. We now have some probably the questions that we will be answering them through email. We have our next session coming up on November 11th, which is in relation to the OECD Pillar 1, Pillar 2. And we invite all of you to kindly join that. Special thanks to my panelists today. And we encourage you to fill out the short survey that will pop up on your screen momentarily, and you tell us what you think about our today's program. If you had joined us late, your presentation will be archived and you can view it in future. If you feel that the others would also benefit from this webcast, please share the webcast via the share this icon or have them visit our debriefs website. We will separately answer your questions through email, and apologies for not being able to address them over the webcast, as we have already run over the time schedule for you. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye and good day. Thank you.